even advocates, I know most of you guys, they are advocates. The process is the same. You go to the bar, you register, and then the thing is that you need a secretary who is going to assist you. So once you have a secretary, then you've got an obligation to register with SARS, and you register for pay as you earn. Register for pay as you earn. When you register for pay as you earn, automatically they register the firm or the practice or the business for UIF. Okay, so even if your employee or your employees are earning below the threshold, one has to register for pay as you earn and UIF. So once you are registered, you can do your declarations where you put a 0 on your pay as you earn because there's no one above the threshold. And then on the UIF, it's always 1%. 1% contribution from the employee. So you should, as an employer, as a business, you should always ensure that you deduct 1% from the employees who are below the threshold and up to an amount of 17,712, you deduct 1%. And you as the employer, then you ensure that you top up and top another 1% for it to be 2%. So there's need to register with SARS for pay as you earn, UIF, and also you need to register with the Department of Labor. How do you register for the Department of Labor? Nowadays, they say you do it online. So you go on their portal, U-filing, they call it U-filing. You go on their portal, you register in your personal capacity. After registering in your personal capacity, then you go on and register the business that you are conducting. So you can register as many businesses as possible that you have under UIF. Like if you are having different, like this is a law firm, you've got a farm, you've got a construction company, you've got a management, like property management company, you come, they register under you as the owner of the businesses. Okay, on that platform, yeah, UIF, which is U-filing. Okay, and then when you register there, you are just capturing your employees, but your payments are done through SARS. You see, and you link automatically, they will ask you for a pay as you earn number, because for them to register a UIF account, they need a business to have a pay as you earn number. So you utilize that pay as you earn number, you go and register, you declare your employees there so that come a time when they want to claim for maternity or you have to slow down activities and you want to retrench, or then they are able to go to the department and claim. So that is how you do it. And also even for your domestic employees, that is the same process for UIF. You create a profile in your name and then you specify that this is for domestic. You register your employee, then you pay through that. Okay. And the other statutory requirement that we have is that one of FICA, Financial Intelligence Center, where we are supposed to make sure that we are registered. So every legal practice is supposed to register as an accountable and reportable accounting and reporting institution. So that means that you are supposed to account for all the activities that are pending in your firm because you are receiving money. You run a trust account, you receive money from people. So they are avoiding money which comes to you, for fraudulent purposes or terrorist activities or money that is deposited, cash, large sums of money that people don't understand and they are proceeds of crime. So they want attorneys to register and it's a requirement and you should report on it to the LPC and also to FIC if ever you come across. So they teach you, you have to go through their act, you have to go through their guides. They teach you how to FICA your clients and also how to come up with a risk assessment model that they require. Okay, so that is our other requirements. Hello? Hello, can you, I'm requesting you to mute. I think it's by mistake. Okay, so that is the other requirement that we have, statutory requirement. So we've got also the last one would be the Workers' Compensation Fund, which is with the Department of Labor, where we are supposed to register all our employees for injuries at work. And each year we are supposed to get a letter of good standing to ensure that we are registered, we are complying. And here and there, they move around offices and then they're checking for these things. So make sure that you are complying and you are registered for that. Okay. Okay, this is 456. 456. Maybe we can take a break. Let's take a 5 minutes break. And then we come back and we look at the other concepts that we have, keeping. And then after that, we can probably work on on an example for a cash book. Okay, let's take a 5 minutes break. I'm going to stop sharing and mute for now. Then I'll come back and then continue. Welcome back. Yeah, my 5 minutes like taking 10 minutes now. Sorry for that. Yeah, any questions before we can proceed? Any queries that you could be having, any challenges that you might be facing? If no challenges, then we can proceed. I think there's a hand. Kirsten Rose.
It's fine. It was a question, but I'd asked my colleague. She cleared it up for me. Thank you.
Oh, okay. All right. Thank you so much. Sorry, if you raise your hand, like I told you, when I'm on the other side, sometimes I can't see. So I can only see it when I come back on the Teams. When I'm sharing, then it doesn't show that there's a hand up. So if you want to interject, you can always, yeah, so that we discuss it whilst we are on it. Thank you so much. I will proceed, go back to our lecture. Okay, welcome to bookkeeping, introduction to bookkeeping. Okay, as part of our course, like what I've said before, this is legal bookkeeping per se, and accounts management, it's just keeping of accounts, like I think that's where they took it, but it's legal bookkeeping. So the concept of legal bookkeeping, they emanate from general bookkeeping and accounting. So we start from there, introduce the concept, which I believe now you are so familiar with them because you started in probably university, you were doing accounting as part of your courses. And it's very good for you because you have to understand your finances. You work for it, you account for it, you live happily ever after, hey? Yeah. Okay, so the difference between bookkeeping and accounting. So you will see in our manual, they will give us the difference. So bookkeeping is generally recording of your transactions. Okay, so you are recording your transactions from the source documents. What is source documents? From your receipts, from your invoices. So that is bookkeeping. So when you are having a bookkeeper in the office, they are the ones who are collecting the source documents, file them in an acceptable manner, and that is easy for auditors to go through, or any other person who wants to inspect to go through. And then those bookkeepers or even administrators can do the filing, and then the bookkeeper will then record your accounting records, your records. So with recording, if you look at our the rules, like I said, they are very important with the sections of the Act. You will find they stipulate that your trust account should be written every other month, balanced every other month. So if I'm to visit you, like now, I expect you are done with your December. It's written, it's balanced, and then now you are working towards working on your January records. And when it comes to your business account, I think they are a bit lenient. They say 3 months should be balanced every 3 months, and make sure you keep record to show that you are balancing. Okay, so with bookkeeping, you can look at systems that one can use. Some people, they record manually. They used to record manually. So manually, I think it's impossible. By using a pen to write every transaction in a book. Okay, some people still do it. But if you are a big firm, it's just impossible. Okay, and then the other method would be some people, they use Excel to record the accounting records. A bit tedious, but yeah, takes a bit of some time to chow most of your time. And then the easiest way, obviously, is to use a system, but using a system comes with a cost. And most bookkeepers, if you are to engage outside bookkeepers, I guess they more of like use Sage, they use QuickBooks, they use Xero to do your trust and business records. Okay. And the other requirement for bookkeeping is that your trust and business records are supposed to be separated. Okay, so if you are using an outside bookkeeper who is not so familiar with attorney's softwares or legal softwares, let's call them legal softwares, then you have to buy 2 databases. You have to buy 2 licenses in Sage, one for the trust, one for the business account, so that you can have both up to date. Or if it's in Xero, I think it's the same thing. You buy, and then, or you can buy where you can create more companies, and then you treat your trust account as a company and your business account is another company, and then you update your records. Okay, and then after updating, okay, the other softwares that can be used, they are legal softwares. I think there's AJS, there is Ghost Practice. Those ones, they need to train you because then they integrate them with your day-to-day work of the practice, and you as the bookkeeper or as the practitioner, then you also have an advantage of then having your books done there. And there are other Ghost Practice, and there are other softwares that you can look at and then you can utilize. Okay, so with this accounting packages, what they do, or if you are handwriting, you find sometimes you handwrite and then you get to a certain level of your bookkeeping, and then from then on you engage an accountant or an auditor and say, okay, now I want to account to the LPC. You know, we are now doing accounting. We are accounting to LPC. So what the auditor will do is that they will take your information, audit it, and produce an audit report, and also your annual statement that you have to submit to the LPC. So you are accounting to a third party. You are giving your information to a third party so that they understand what your firm is doing. Okay, and then also accounting in terms of SARS, they require financial statements for your business account for tax purposes. Then you take your records, give them to an accountant or a tax consultant. Then they produce the financial statements, and then that's the difference between bookkeeping. Bookkeeping, you just make sure that you update, you have everything at the office in a system, back it up, it's there. Accounting, then you are doing it for the third party so that they can understand further what is happening in the practice in terms of finances. Okay, and the next one is the importance of bookkeeping. Why is it important? So the most important thing is that it's a requirement by most legislation requires that we keep our books. We have to account for them. So the first one would be like for tax purposes, we have to account. So it is important that we do our bookkeeping. And for LPC, they want us to report and they can come for inspections. So this is very important. You need to have a bookkeeper. You need to also or do your bookkeeping or appoint someone in-house to do the bookkeeping so that when they come for inspections, at least you can answer everything is up to date, filed, properly done. And the other importance of bookkeeping, then when you have these reports, then you are able to tell who are my debtors, who are the clients that are owing the practice, who are the clients that are owing the practice. So you can draw up a list and say, oh, okay, so and so is owing so much, or so and so is overpaid. And then if they've overpaid, you can look at reimbursing them or moving their money into the trust account until such a time their matter has been finalized and you can take your fees. Okay, and then the other important thing is that you can tell if the business is making a profit or not. Very critical, very crucial, because you cannot continue just running blindly. You know, even if you are good, very good at defending your clients in court, without money in your pockets, I don't think you will be able to sustain it. So you need to then have someone who is always giving you an update, management accounts on a monthly basis to show you how the practice is performing. Are you collecting enough? You know, after running with your matters, is the money which is flowing? Because at the end of the day, you know, cash flow, it's like the major thing that is important for any business to continue running. So you need to make sure that you are doing your bookkeeping. And then the other thing, you will know your creditors, and also you will know which assets are you having and where, because with accounting, you have to keep an asset register. And then with that asset register, then it can give you you can be able to tell, when did you buy something? Is it still available? Is it still depreciable? Is it usable? Can we sell it? So you are able to make your decisions because of bookkeeping and accounting. Okay, and then the next thing, let's talk about get into bookkeeping, the theory of double entry. Okay. With bookkeeping, I'll illustrate it when we are doing our example. We've got a principle that we call double entry. That is what carries us through into accounting. So you have to understand that when we are posting transactions, every transaction has got two entries. Every transaction has got two entries that we do. The first entry, it's on the debit side. The second entry is on the credit side. So you have to look at the two accounts that are affected by a transaction. So say, for example, we are buying stationery for our office that we're going to keep and use over a period of time. So we are affecting our bank account in that we are going to withdraw money, or we are going to swipe and reduce the bank account. So that bank account is affected by that transaction. And our stationery account is going to be higher. Why? Because now we bought stationery and we've got our asset at the office, which is that stationery. And then when we are using it, then we start expensing it. Or if you buy and distribute to your employees immediately, then you can make it an expense. So you have moved your asset, which was cash, into an expense. So you are debiting the expense account, you're crediting the bank account. Okay, that is the double entry theory. So every transaction, no matter how petty it is, we account for it double entry. It has a double entry. We have to ensure we do that. Okay, and the next thing is the accounting cycle. Let's have a look at the accounting cycle. Accounting cycle. This is our more of like our accounting cycle. So basically what we start with every transaction that we get into, we start with the source document. What is the source document? So it's the original. Say, for instance, I go to Makro, I am buying, they will give us an invoice. So if we collect those invoices, if we collect our deposit slips, if we collect our petty cash slips, and if we invoice our clients and we collect that and we file, and we collect our bank statements and we file them and we keep them like that without doing anything, then we won't be able to tell what is happening. Then because you can't tell how much we've spent, what are our expenses, hence the principle of what bookkeeping, to say, okay, let's do our bookkeeping, let's record, let's see, let's make decisions out of this. So this assists us in making decisions at the end of the day. We can control our financial resources. Okay, so our source documents, those are the documents that I was telling you. We collect them, our bank statements, our invoices. We start from there. And then what we do, we capture them. So when we are capturing when we have a bank statement, when we are capturing it, we capture it in what we call a cash book. Okay, so for the business account, every account should have its own cash book, because we are going to balance that account against its bank statement. So if you mix the banks, you won't be able to balance because you will have a lot of transactions that are now mixed together, and you won't be able to trace. So a cash book should be relating to your particular bank. Okay, so we capture in a cash book, and then that is our book of prime entry. It's the initial book that we are capturing in. And then from there, like if it's our invoices, if we are doing it manually, we would list our invoice in an invoice book, and then we list in an invoice book to show our fee, because at the end of the day, we want to tell what is our fee from our invoices, what is the VAT that we have levied the client. So we do that in a fee book. Okay? And then it goes on and on. Usually, most of the prime entry books are, say, in manufacturing companies, but us as law firms, usually we utilize the fee book, we utilize the cash book. And petty cash, we do a petty cash book for it so that we can properly account for the cash to see how we are drawing it down, how we are replenishing it, how we are drawing it down, just like that. Okay, and then from our books of prime entry, they are more of like having one leg of the transaction. Remember, we said it's a double. So it's one, they will record one, either a debit or a credit part of the transaction. Okay, and then the second leg then goes into our ledger. So our ledgers are the ones that then carry the second leg. So say, for instance, we bought water for the office. You see, water, we bought coffee for the office, groceries for the office. And we used our card, we swiped at game we bought there. And then our first leg, it's in the cash book. So our second one will go into our office refreshment account. So we are now recording similar transactions. So a ledger is used to record similar transactions. If it's your refreshment in their own account, your telephone expenditure in their own account, your insurance, when you're paying the insurance in its own account. So the idea is that at the end of the year or any given financial period, we add up. When we add up, we come up with balances. Okay, and then these balances, we take them through to what we call a trial balance. So since I've said that each transaction has got a debit and a credit, the idea is that if you take balances and you've done it properly, when you compare your debits and your credit balances, they should balance. And then we call that a trial balance. And with the trial balance, then it assists the auditors, the accountants, with preparation of financial statements, preparation of management accounts that are then used for decision making. So this is our accounting cycle, from the source documents, first entry into ledgers, trial balance, make any adjustments if you made errors, and if we've got items like non-cash items, we make adjustments, then we prepare our financial statements. Happiness, any questions? Okay, so I'll more of like go back to our book introduction to bookkeeping, and then where I said that was our accounting cycle, and then we have got what we call financial periods or financial years. Okay, so it all depends with the nature of the business. If we are running as a sole practitioner, as an individual running their own firm, so the taxes, the financial year is determined by SARS for individuals. Every individual in South Africa, their tax year run from March up to February. March up to February for every individual. So it means if you're practicing as a sole prop or as an advocate or partnership, then your financial year is going to align with that, because your profits are going to be taxed under you. You see, you don't declare an income, you declare profits. So you say, I'm running a business. This is my income. These are my expenses. So according to the Act, what is income, you treat what is income according to the Act. What is expense, what is acceptable as an expense, and then what is left, it's your profit. And then out of that profit, that's where you get taxed. You see, so that's where when you are reporting to SARS, you start from that income. Hence, I was saying it is important for us to do bookkeeping because they will want to see your total income. You cannot just declare the profits. You have to declare this is my income. They can say, send us your books so that we can see your income. Then you can send them. They can decide to pick a sample and say, send us invoices. If it's expenses, you are saying you have spent so much on rent. Can you send us invoices to show that this is an expense of the business? Okay, so when we are looking at expenses, so you need to separate yourselves. The reason why we have a business account and a personal account is that you need to separate yourself from the business, and expenses that run through the business account should be business expenses. And business expenses are the ones that are incurred, expenses that we incur, payments that we make for us to generate the income. Okay. At the office, we spend that, we generate the income. Okay, so you separate from personal. So your groceries, your clothes, if you go with your children, buy toys, those are not business expenses. Okay, all right. So I think I've diverted a bit. I was on financial years for individuals from March up to February. And then for a company, so as legal practitioners, especially attorneys, they are allowed to register a company where they can have one or two or more directors. And in that company, they call it an incorporated company. Why it is called an incorporated company? It's because the liability of the company and that of the directors are not separated. They're together. So there is what they call it a personal liability company. So the director is also liable personally to anything that goes wrong. Because remember, our nature of industry is that we are offering a service, a personal service to our clients. So we are advising them. And if anything goes wrong, if our law firm or our legal practice is to be sued, we are part of the system, we are part of them, we get sued together. So hence it's called incorporated. The other companies that are there, like there's a private company allows anyone to open it, carry on a business, and you can appoint directors. You don't have to be a director, but you can be a shareholder, and then you enjoy the benefits of your company. Other people work for you, so you are not held accountable together with the company if someone makes a mistake. You see, the liability is limited because you, as a shareholder, you can separate yourself and say, I gave people resources. I asked them to work, then they worked, they made their mistakes, sued the company, then the company is sued on its own. Its assets are sold, or it also sues its own capacity. Okay, and this also applies if you look at listed companies. It's the same principle. They are listed on the stock exchange. We buy shares. We are shareholders. It's our company, but we do not direct it. It has got its directors, its employees who run day to day, and then they will come back to us as shareholders and say, we have worked hard, your dividend is so much. Then that's our return on the investment. Okay, so with such companies, I'm coming back to the financial period. Those companies are registered with a CIPC, used to be CIPRO. or the company registrar, it's the Commission of AIPC. Yeah, it's a commission that registered companies for us. So what it does is that when it registers a company, it requires a year end. So the person who is registering the company for you can give any year end between January to December. They can say the year end is February. They can say it's January. They can say it's November, it's July. It's up to the person. So it's your discussion with the person who is registering. But the year end can be changed. You can change it. The best one is to align it with the individual one, which runs from March up to February, from March up to February, so that when you are doing your reconciliations, it's easier to reconcile. But financial periods, you can always run January to December in a company, as long as your company registration certificate stipulates that it's your year end is December. Then you adhere to the 12-month cycle. So it becomes a 12-month cycle, 12-month cycle. So you have to do a cutoff, start a new period, report a new period, start a new period, report a new period. So your income is not continuous. It is reported according to 12 months, every 12 months, whether individual or company, it is recorded like that. And then the next thing is our trust audits. Okay, trust audits are supposed to be done every year. This is a requirement of the LPC. They are done every year. So it also depends with the year end that you choose with the LPC. The one that is normally used by most people, the common one, is February. So most people, what they do, they make sure that they just align with Feb. And then what you do is that February becomes your year end. You are given 6 months from February to report to the LPC. You have your audit reports submitted by your auditor and yourself. You ensure that you have submitted to avoid penalties, because they also charge a penalty. They call you for disciplinary hearing. They can even strike you off, or not strike, probably suspend you if you're not submitting your audit reports, because they utilize that information. They check. There is a department which is there which checks to see if you are complying, because your auditor has to report if you are complying to with those rules that I was telling you about, if you're complying with the act. So if there are any deviations, the Law Society will come, they will do an investigation. Okay, so those are our trust audits. If you are starting your new practice, I think they require an opening audit, which is the first 4 months, which should be submitted in the first 6 months. So there's an opening audit. If you are closing your firm, you are done with practicing, you notify the LPC, they need to be notified. If you do not notify them, according to them, you are still practicing. So they will require an audit report. They will require an audit report. So when you are closing, you need to notify them, I'm closing. You notify the bank, close the trust account, give them proof that the trust account is closed, do a closing audit. If it's not aligning with the financial year audit, then you do a closing audit for the months that you've been running. Then you are done with the LPC. Happiness, any questions? Okay. Our last chapter, hopefully I'll be able to go through the example, is on cash books. So I think I've done a little bit of explanation so that I don't take a lot of our time, so that we can do an example in the last 20 minutes. Cash books are very important. That is, bookkeeping, it emanates from a business having cash books, because we are now utilizing banks. So with the banks, we need to account for the transactions that go through the bank account. So each bank account. So for our trust, we need to have a trust cash book. If we've got 4 trust accounts, we will have 4 trust cash books. Okay. Why? Because we need to reconcile each cash book, then it becomes easier for reconciliation. Business cash books is the same, different cash books. If we've got a business account, a savings account, an investment account, so we'll run cash books for each account. Okay, and then for petty cash, we run what we call a petty cash book. Why? Because we want to account for the money that we have received, expended, and then we see what is on hand. So we should always agree. Okay, and then I've explained that from our cash books or books of prime entry, the second leg of the transaction goes to the ledgers. So with the ledger, we've got what we call the general, for the business account, we've got what we call the general ledger. General ledger, it posts just the general transactions. And then we've got a client's matters ledger or our debtors ledger. In our normal business language, we call it a debtors ledger. So that one we are posting all the transactions that pertain to our matters on the business side. So it's a client's business ledger, matter ledger. And then we have on the trust side, the trust account, it's easy. It has got cash books and trust creditors ledgers only. No other funny things that goes on. So it's between you and the client, So cash book and the client's ledger. So if we receive money on behalf of someone, we're supposed to track it against that person's ledger. So if we pay an advocate, we are posting in that client's ledger. We are not going to create a ledger for the advocate because the advocate is not our client. Okay, so I'm talking in the sense, I'm taking it, we are a law firm. Say, for instance, we are a law firm, an attorney's firm, and we deal with advocates on behalf of our clients. So when we get money in the trust account, we are supposed to then pay the sheriff, we pay the advocates, we pay the trusters, we pay SARS. So all those payments, they are posted against the client's ledger. The client's ledger, not create ledgers for service providers. To us, these are service providers for our client. We are paying to or on behalf of our client. So we account to the client to say, your money, this is what we have done with it. We don't account to the advocate. So that's the trust principle. Trust cash book, client ledger. Trust cash book, trust creditors ledger. Those are the two. The only other thing that we have is the interest. So as part of our trust creditors ledgers, then we have the fund account, which we should account for the interest. Receive it, we remove bank charges, and then the net, we more of like pay it to the dividend fund. So now they've done a sweeping system. It's easy. The money goes to them, so you can easily just account if then. So you need to ensure that you're on the sweeping system when you register your firm or your trust account. You instruct the bank to put you on the sweeping system so that the net effect is paid to the fund without you putting any effort. Okay, and then that is our other creditor that we have. Okay, so when it comes to our trust cash books, our ledgers, we need to reconcile them. So we need to reconcile our cash books on a monthly basis so that we check if they agree with the bank, if there are some deposits which are made, not yet presented, what could be the matter. So reconciliation assists us in checking accuracy, completeness, and ensuring that our money is guarded. Okay, so for the trust account, for each cash book, we do a reconciliation, compare the closing balance of the cash book with that one of the bank. If there are differences, then you can go through that section in the book. It explains very well if there are differences, what you are supposed to do. Record all those transactions in the cash book, which are not errors, you go and record them in your cash book. And then what is in your cash book and not in your bank statement, then those are your reconciling items. Those are your reconciling items. If you make errors in your cash books, you correct them in your cash books. They are not errors that go to the reconciliation, to a bank reconciliation. So you look at that and then you attend. And then also we need to frequently reconcile our other ledger accounts. Like if you need to scrutinize your telephone account. If you can see that, oh, it has got something that does not relate to telephones, then you make sure that you pass your journal entries, you move it. Reconcile your debtors, your clients' accounts, so that you see sometimes we post by mistake. And then if we do not reconcile, check them, you see, then it will be difficult for us to tell. And then when it comes to our creditors, for Telkom, I think those who provide services like softwares, when they give you invoices, you check if you have captured all the invoices, if they've also processed payments that you have made to them. So that's why you need to reconcile. That is the importance of reconciling. So every month, make sure you are reconciling. Okay, so let's have an example. I think I've said a lot, and I hope you are following through. That's the challenge with the webinars. We just have to say a lot. Okay, so let's record. We have an example where we are supposed to record in a cash book and a ledger. I'm not going to most probably cover all of it because of time, but I will just kind of like introduce you on how our cash book works. So our cash book, it works as a T account. So it's more like it's a T account. So I'm going to open our questions and our workbook so that we work on it. So I'll stop sharing and then any questions? Well, at least I'm doing my marathon here. Okay. Okay, I'm going to share now the example that we're going to do. Well, let's share the screen. This is our screen. Can you see it? Is it clear enough for you? Yeah, I hope so. So what I'm going to do, I'm going to minimize a bit. You won't be able to see, but I will enlarge the cash book. So a cash book, just like what I've said, we've got what we call a debit side and a credit side. So for a cash book, it's easy. Our debit side, that's where we receive money. You see, any money that is going to be paid into our bank account comes to the debit side. So automatically we then just name it receipts because it's going to be our receipts. And then what we pay, whatever that you are instructed to say it was paid out of the bank account, it goes to the credit side. So this is, they call it a T account because here we take it like this. And then this is the middle. It divides this middle line. It divides the debit side and the credit side. Then they call it a T account. Okay. So with our cash book, we are accounting for our cash transactions. And with our ledgers, that is where we post the second leg of the transaction. Okay. So let's start. I hope you can see both the PDF and the Excel. Okay, so we are told record the following transactions in a trust cash book and business cash book. Okay, and then on 1 August 2020, we've got an opening balance of 5,000 and it's a debit balance. Anyway, the trust is not, you're not allowed to have the trust account to be on an OD. overdraft. No, it should always sit with money. So what we start with, we'll record the date, 1 August 2022, and it's our opening balance. Okay. That, and then it's 5,000. Okay, so this is our debit side. This is our credit side. Let me kind of like highlight for you a bit so that it becomes, I don't know if you can see. If you can't, I can enlarge. Okay, this is our debit side, which I'm highlighting with green. So this is where we receive money. This is where we pay. So let's highlight it another color, maybe yellow, like that. Okay, so then it forms the T that they talk about. And let me enlarge. Like that, debit and credit, so that you can see. And also I'll try to minimize the question so that I can read the question so that you can see how I post. Okay, so with the opening balance, unfortunately, we are not told whose money is it. So I'm not going to, for now, I'll just leave it. But when we are doing, when we give you questions where you have to prepare ledgers, we tell you to say there was an opening balance of 5,000, 3,000 was for so and so, 2,000 was for so and so. So that is the benefit of us keeping records. And then on 2 August, Mr. Govender deposited 50,000 in the account for a litigation matter. So 2 August. So it's a deposit, it's a receipt. We issue a receipt to Mr. Govender and we record it in our cash book. And in this case, it's Mr. Govender. So the other thing that you need to do, like for your practices, maybe you need to, if it's a big one, you might need to do file references, and then you utilize file references. Otherwise, you can always utilize the names, and then you make sure you check it according to the name. Okay, so the amount is 50,000. That's what we received. So we debit our bank with the 50, and then the double entry. I've created a ledger already. It's a T account, just like the one above. We record it's 2 August 2022. And where is the money? The money is in the bank account, which is our trust account. I am assuming we've got one trust account. So if you've got many, then you can stipulate FNB bank account or a FNB cash book 2 if you've got 10 of them, so that you can easily trace. You will know which one is cash book 2, then you can trace it. Okay, and then 4 August, SAPS paid 40,000 into the trust account on behalf of Mr. Maluleke. So we are receiving money here for August 2022, Mr. Maluleke. So it's coming from SAPS. So it's a matter. So I'm just going to do the way that you guys do with your matters, Maluleke. Like that, Maluleke. Okay, like that. And then how much are we receiving? 40,000. So this is how we record it in our books. Okay, 8 August, we paid Advocate Fantonte 10,000 in the Govender matter. So now we are paying. Oh, sorry, I haven't done the double entry. So this is the 40. We go to Maluleke's ledger account. We record it. So it was on 4 August. 4 August 2022. And it's bank coming from SAPS like that. How much? 40,000. I'm recording on the wrong side. I'm so sorry. I'm doing another debit entry, which we were not going to balance at all. So it's SAPS, bank, SAPS, like that, and then it's 40. So this is the debit entry, which is here in the cash book. And then this at the bottom is our Maluleka ledger with the credit entry. Okay, and then we pay Advocate Van Tonte on behalf of the Governor Matter on 8 August. So on the payment side, we are now paying. Okay, so it's Governor, is the file of Governor, and then we are paying Advocate T. How much are we paying? 10,000. So this is how we record our payments. So the double entry will come into the ledger account of our client. Okay, our client Van Tonte, which is bank account, and it's we've paid Advocate like that. How much have we paid? 10,000. So we do not create an account for the advocate. Okay, we do not create an account for the advocate. What we do, we create an account for, we post in the account of our client, just like what you guys do when you are accounting. When you do your statement of accounts, you would show what you have done with the client's money. This is what we also do in accounting. When it comes to the trust account, we show what we've done with the money that we have received. We received 50, and then we paid on your behalf 10,000. Okay. And then the next one is 12 August. We paid 30,000 as a final settlement for Mr. Maluleka's matter. So we are paying Mr. Maluleke, and it's 12 August. So we are paying 12 August 2022. Okay. Settlement, ne? We've done the matter. SAPS has paid, and we agree on what a fee of 40,000, a payment to him of 30,000, and yeah, that's what we do. And then we show that it's a settlement, final settlement, and how much? 30,000. Okay. So if we can look at it, at least if we look at Maluleke, we've paid him. So we received 40, we paid 30. So the 10 will account for it as we are told. Instructions given, we account for it. 25 August, we transferred our fee of 15,000 from the Governor Matter. So we are transferring our fee. We come here, we record our fee. 25 August 2022. And then it's Governor, Mr. Governor. And in this case, it's our fee transfer. Okay, we are running out of time. I think for our business, I think for our trust account, I think I have illustrated. You should be able to do your assignment like that. So this is the double entry. So it's bank account. What are we doing in the bank? We are taking our fee. So how much is it? 15,000. So this is how we continue accounting. So this is how we are going to post these transactions into the various meters until you get to the end. Okay, so because we are running out of time, I'm not sure if you want us to go through the business account, because our assignment requires us to do the cash books. So if there are those people who want another 10 minutes for me just to illustrate the business account, then please let me know. I'll stop sharing, and then I see by those who raise their hands. So if there are some, then I'll illustrate the business. So the concept is the same. What you have received on the debit side, what you have paid on the credit side. Okay. Okay, all right, I've got 3 people who are saying we should continue. Okay, 4 people. So let me just quickly continue, do another 10 minutes, and then we'll finish up. But for those who feel like they want to go, thank you so much for attending the lecture. I hope it was beneficial for you. I don't want to delay you, but the idea is that we just want to kind of like talk to you guys, give you more info, and then you can carry on with your assignments. Okay, so I'm going to go back to our assignment, and then we can finalize. Okay, so for the trust side, I think we were left with 2 transactions.
Sorry, before you continue, can I just see your Excel spreadsheet on a full
page?
Yeah, so I just want to take a screenshot and copy it and paste it on my Word document as an example.
Oh, okay. All right. So what I'm going to do as well, after doing this, I'm going to share. I will share it on the platform.
Okay, thank you.
Yeah, this is the cash book.
Sorry, can I just ask a question as well, please?
Yeah, sure.
For the purpose of the assignment, am I correct in saying we only have to do the cash books? We don't have to do the ledger accounts as well for the different matters. It's only the cash books.
It's only the cash books.
Okay, thank you.
The cash books. Yeah. Any other questions before we can continue? Yeah, I'm going to minimize. So this is our trust cash book. Okay, so we're posted up to taking our fee. Let's just finish. I think we are left with 4 transactions. And then we are told on the 25th, we paid the sheriff 250 rands on the matter of Maluleke. So we are paying. So it's on the credit side, 25 August 2022, Maluleke. And then this time we are paying the sheriff. So you see, we relate our payment, we relate it to our file. We always relate to our file so that when we are tracing, we want to know this sheriff, which matter was he paid for? So it's for the Maluleke matter. And then when we come to the ledger account for Maluleke, then we are able to post. We are able to post, like in this case, then it is the bank account and it is for the sheriff. We're paying the sheriff. The sheriff. And how much are we paying? We're paying 250. So this is how you post. So on our next assignment, you will be doing 4 ledgers. And 25 August, we take our fees from the Maluleke matter. So the good thing about accounting, if you do it in real time, is that you will be able to tell if you are taking more or you're not taking more on a matter because you have a ledger which is running. Okay, so this is our fee. How much is it? 9,750. I hope you can see this part, 9,750. Okay, that is our fee. So if we come to our ledger for Maluleke, and then you can see, if you look at it, what is left, it's that 9,750. So if we were to take 10,000, we're going to be in a debit. We have a debit balance, and it was going to affect us because the auditors can decide to report and it's not nice. 49750. So you need to do your bookkeeping. Make sure you're always doing it. So that's how we do it. And then the next one is for the interest. So interest is a receipt, money coming into the account. It came on the 31st of August 2022. It's interest. How much is it? 520. Okay, and then with interest, where you see your interest is higher than your bank charges, so automatically you also come and do the double entry into the account of the LPC, so that you can easily account for it. 2022, so it's interest. So it was a receipt on the debit side. When we come to the LPE, to the legal practice funds account, we come and credit it. How much? 520, just like that. So we have finished our double entry. So it's not our money. So we are not going to treat it as fees or as other income or as interest earned. We haven't earned it. It's not ours. So don't post in any interest earnings account, because it has got nothing to do with our practice. It's to do with the LPC or the LPFF legal or the fund. Okay, and then the bank charges. The moment we see that the bank charges are higher than interest, then we know we are sorted. We are not going to pay bank charges out of our own pockets. It is going to come out of the interest amount. So it's a payment, the bank is taking its money. How much? 324, just like that. And then when we do the double entry, we go to that one of the fund, so that at the end of the day, what we are left with is what is payable to them. And then our description, it's bank charges. So these bank charges are not the practice bank charges. So you are not supposed to create a bank charges account when you are doing when you are answering. You're not supposed to put them there, because if you create a bank charges account, then you are telling me they are business bank charges. In this case, they are not. It's trust. So we are doing a trust. We are accounting for trust transactions. They are not our bank charges. They only become bank charges of the firm where we are not earning interest. The fund will say, nope, I'm not going to cover that for you. It's either you claim it from the clients or you make it your own business expense. Okay, but where we are earning interest and it's higher than bank charges, we treat it in the funds account, just like that. So this is how we record our trust transactions. So what I will do is that I'll post the question, and I'll post also this example that we've done. Okay, and then when it comes to the business account, the concept is the same. The concept is the same. What we receive on our debit side, what we pay on the credit side, the concept is the same. So when you look at it, opening balances, they will stipulate opening balance 3750, and it's a debit, because with a business account, we can ask the bank for an overdraft. And when we ask the bank for an overdraft, then the account can be in an overdraft. See? So this is our opening balance. And then normally when we then are doing ledgers, we will also tell you what that opening balance is made up of, so that you can balance. When you do your trial balance, you should be able to balance. And then 2 August, we pay Telkom 750. So my assumption is that when we are paying Telkom, it's an expense that we are paying directly. We have not created a Telkom as a supplier in our books. But if we have, then it means Telkom is our creditor. What we do is that we create a credit. When we receive an invoice, then we first of all account for the invoice, and then when we are paying them, then we are just crediting their account. But in this case, I'm just going to assume that when we receive bills from Telkom, we pay immediately. When we receive, we pay immediately. We are not in arrears. We are not going to be in arrears. So when we are paying here, we pay Telkom 750. Because if we were in arrears, then we are supposed to start with an invoice. And then from an invoice point of view, then we do the payment. Okay. So this one, I'm posting it to the telephone account with the assumption that it's not a creditor to us. Okay, so it's Telkom. So it's from our bank, and it's Telkom. How much is it? 750. So we immediately expense it. And then for August, we bought stationery for cash at CAN for 300. So it's our business account. So it's not like we withdrew and then we bought. Most probably we are using our card to buy from the business side. So when we post, when we are buying, it's like a payment. We are taking money out of our account. So for August 2022 and CAN, and it's stationery 300. So we go to our stationery account, printing and stationery account, to do our double entry. We post that. How much? It's 300, like that. So that is how we do our double entry. So I think it's almost time. Let's do our last one, which is the salary. So with the salaries, in this case, let's assume we are just paying them in full. We're not doing any payroll. So we are told we are paying the secretary an amount of 6,000. Next time, I'll illustrate how you do your payroll and then incorporate it in your accounting records. But this time, let's just record as given. So we are paying our secretary. How much are we paying? 6,000. Like that. Okay. And then on 25, and then we withdraw 5,000 for. So the attorney is withdrawing 5,000. So this one that we have paid the secretary. So when you're doing your double entry, you always remember to post in your ledgers. So it would be this one, the secretary. How much? 6,000 straight. Like that, that's the ledger. And then if it's a drawing, so there's a drawing, 25 August, the payment. So it's a drawing for the member. And how much is it? 5,000, like that. And then when we come to our drawing, so we create a drawings account. Let's see, here's our drawings account. It's part of our APT. And then we are reducing our money in the bank. So it also comes to the debit side. So it's from the bank account. And how much is it? 5,000. So this is how you do your double entry. And then we pay rent to MST Investment, 2,500, 2,400. We are paying. So when we are paying, we utilize our cash book. The rent to MST, like that, 2,400. And we also go, so if we pay immediately, if everything is COD, then it means we can expense it immediately. But if we've got an account, we pay in arrears, we've got issues, then we have to treat them as a creditor. We take the invoices, we capture them, and then we capture the account as a, but in this case, let's assume our things are in order. So in your rent account as well, if you indicate that it's MST, it will be easy for you. Say, for instance, you've got 4 properties, you've got 4 premises, one in Pretoria, one in Joburg, one in Middleburg. Then you'll be able to tell, oh, okay, MST, we've paid them, but we haven't paid whoever, another probably landlord. So you put as much detail as possible so that you are able to account. And then 25 August, we purchased a computer monitor at Incredible Solutions for 799.99. So it's a computer monitor. So it's one of, like, part of our computer expenses. Same day. So it's a computer monitor. So it can be computer, it can be an expense. Anything less than 7,000 can be expensed. So you can expense it, or if you want to capitalize it and account for your assets, then you capture it under your computer equipment. 25 August 2022. So it's a computer monitor, bank. So it's a monitor. So it's more of like, if you want to capitalizing it, will always make it easy for you to track, because otherwise some of these assets, once you expense them, you forget about them. Okay, because these accounts of assets accounts, they carry over for a period and you account for them frequently. Okay, and then our last transaction, it's 31 August. We paid bank charges in the amount of 180. So on 31 August, then the bank took its charges. Okay. How much? 180, like that. And then we go to our bank charges account. Bank charges account. So you can create these accounts, these ledger accounts. You can create them. With me, I've done a pre-thing so that, much is it, 180, so that we can be faster. And then the last thing is that when you look at our trust account, we remember we did a transfer, a fee transfer. I think we've done them twice. So each time when we're doing a fee transfer, it affects our business account. So we were supposed to also post it. So a transfer has got 4 entries. One, it affects the trust and the client. It affects the business account. And as well, usually we can only do a transfer after we've raised an invoice. So the transfers that we did were 25 August for Mr. Gavinda, 15,000, and then for Maluleke, 975. So when you come to our cash book, it's money that we received. 2022, Mr. Gavinda. So, or we can say fees, Mr. Gavinda, or fee, Mr. Gavinda, which is 15,000. And then also we got our fee from Maluleke. How much? 9,750, like that. So these ones, then they are supposed to be posted on their respective, after we raise invoices, we post and credit their accounts so that we clear them. They have paid us and then we are done. So this is how you more of like capture the transactions in a cash book. Let me highlight, let me make it big. Okay, like that. Okay. And then, so how we balance off our cash book? We look at the side which is bigger. So in this case, the side that is bigger, it's the debit side. So we take the debits, we subtract that one which is smaller, and then we have our balance. This is what we are carrying forward. So when we come here, we go to the side which is a less. That's where we post our balance so that both sides can balance. So you can see here there's a 28.5, there's a 28.5, and then that is the balance that we are going to carry over as our opening balance on the 1st of September 2022, just like that. So that's how we balance our accounts. Every account, you look at the side which is having a lower balance, that is the balancing side. And when you move, it interchanges to the opening balance. If this balance was coming to this side, then when we start September, it was going to move to shift to the side, which means our debits are more, we've got more money on the debit side. Okay, it's not an overdrawn account. All right, this is the illustration of our cash books and our ledgers. I'm going to post it on the group. I don't know if you have got any questions. I know I've stretched you too long. Yeah, you can ask. Is it? Yeah, please, you can ask. Okay, it appears we don't have any questions. I want to thank you so much for, I have taken your time, I've extended a bit so that we could cover everything, and I wish you all the best in assignment 1. Once you are done, then we can mark it and then we see how we are doing. Okay, thank you, have a good night.
Thank you very much.
Thank you.
Thank you
Thanks.
very much.
Bye.
Thanks so much.
Thank you.